Stock markets have generally had quite a poor week this week, driven largely by the corporate earnings that have been coming out from the US. We're right in the midst of the corporate reporting season, but it's fair to say that reactions to results which have generally been in line or just above expectations has been poor, and that's more to do with the outlook statements that are being guided. Companies like Caterpillar, for example, guiding down their expectations for the year, seen as a barometer for global growth. And in Europe, we've had lots of forward-looking data. The press this week will, of course, be focusing on the UK's growth numbers for the third quarter, which were generally perceived to be quite good. But in terms of Europe, some of the forward indicators, things like PMI surveys, are looking notably weak, very weak indeed, and indicative of contraction, further contraction in the European economies. Indeed, even Germany is looking at a contraction maybe in the fourth quarter, which is not going to help the UK in terms of its export potential. So as mentioned, if those UK numbers are being cheered this week for what looks like a good bounce back in the third quarter, I don't think it's necessarily time to call the end of the recession at this stage. So let's just take a look at the markets, and we commented about the fact that certainly some of the US markets had been nudging towards those high levels, but it has shied away from that. We've had two or three sort of fairly significant movements on the markets this week, generally down, and so we're certainly shying away from that particular area on the Dow Jones index. If we also take a look at the FTSE 100, again, really just nudging that 5,900, 6,000. It's an area that it's really found very difficult to break through now for quite a considerable period of time. Things were obviously looking very good as we showed this chart last week, but we have again see it shy away back down to the just below 5,800 level. And of course, we will be coming ourselves into a reporting season here in the UK, so it'll be interesting to note as to how UK businesses are going to present themselves over that period of time. I think generally the backdrop for the UK market remains one of range-bound markets, and that may well persist, particularly until we get through the US election, which is now just a fortnight away. It's because the US election is creating so much uncertainty. There's not a clear-cut winner at this stage that I think markets do feel just a little bit on pause and a little bit range-bound whilst that event takes place, because that will have ramifications how they deal with the next big issue, which is the US fiscal cliff. So let's just take a look at some other charts that I find interesting at the moment. This chart here shows copper. Copper is just a barometer for really what is happening in the hard metal space, and we can see here that from a sort of rally in early September, generally metal prices have been coming under some pressure across the globe. Not sure necessarily what the reason is behind it, and indeed supportive data to hard metals has come out of China. We've had PMI surveys and GDP numbers coming out of China over the course of the last week or so, which have been generally perceived as quite positive. Indeed, Jim O'Neill at Goldman Sachs has been on thinking that China is going to see a bounce back in the course of the next quarter or so. So any fears that China was really sort of boiling over may be misplaced on the back of those numbers. And I would have felt that hard metals would have possibly had a better period than this, but we are seeing some come under pressure at the moment. But if one's looking for a fourth quarter rally, I would certainly suggest that the mining sector, stocks like Rio Tinto, Billiton, for example, may well be worthy of a look for the final quarter if we are going to see that rally. Also, oil has been notably weak over time. Hard to read as to is that positive or negative for markets. Clearly, it's meant that stocks like BP have come under a little pressure over the course of the last week, despite the fact that they've concluded this deal in Russia, which I think has generally been received favourably by investors. But oil coming under a bit of pressure. But that's the flip side of that, of course, is that is acting as a nice stimulant to the US economy and consumer spending. I think it's worthy just bringing the Apple chart up again. It's shied away from $700 back down to $600. Started the year at $349, so it's clearly had a very good year. Top's coming off it at the moment. And that, in effect, is one of the reasons why we are seeing some weakness in overall markets, because Apple, Google, these sort of stocks are having such a big influence now on the S&P index. So again, just a quick glance at the sterling. Sterling's generally had quite a good week, and it comes off the back of these third quarter numbers. And I do think that we're in an interesting junction for the UK economy, because we are seeing, as I say, stronger third quarter numbers, but we also heard from Mervyn King, the bank governor this week, who really seemed to suggest that the bar for further QE is a little bit higher than possibly markets were expecting. A consensus was for more QE to be coming to the market during the course of the fourth quarter of this year, maybe another £50 billion or so. But he sort of indicated that he's reasonably comfortable with the rate of growth that we're seeing at the moment. He's certainly comfortable with what's happening on unemployment. Things suggesting to me that it was unlikely in the fourth quarter now that we will see further QE. QE does depress currencies. It certainly acts as a depressor of currencies. So any conversations about QE not happening in the fourth quarter has been generally good for sterling, and we are seeing sterling pick up on the back of that.